Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Sonesh Shenoy and Pavitra Parekh. And after a quiet, flat start, the Nifty opened around levels of 18,060. Things have picked up for our market. So now we're comfortably above that 18,100 mark. The last 1 hour has been very steady for our market. The benchmark indices are up close to about 0.3%. The mid-caps are more or less keeping in step. The advanced decline ratio is positive. 3 stocks in the green for 2 in the red. The Nifty is now trading well above its 20-day moving average. We crossed that hurdle in yesterday's trade, and now there is a fair amount of gap between where we currently are, that's 18,112, and our 20-day moving average. The next pit stop or the level to track will be on the way up, our 50-day moving average of 18,288. But if you just take a look back at what the first fortnight of 2023 has been, and you would see it's played out completely contrary to street expectations, right? The expectation was that India will continue to outperform the rest of the markets. That's not played out. Year to date, you have markets like Hang Seng up 9%, the Korean markets up 5 to 6%. In that context, India has lagged. The narrative was also that the FIs who sold India in 2022 will come back, but the FIs have sold. Yesterday, you did have a little bit of a buy figure, but it was not a big, significant amount. But broadly, in the first 2023, the first 18 days, we've seen the FIs sell close to 17, 18,000 crores. PSU banks have underperformed, while IT, that's where the maximum concerns were. IT has outperformed. So the PSU banking index is down 2%, while the Nifty IT index is up close to about 3.5%. And watch for the IT index. It's showing considerable amount of strength. The Nifty IT index has been closing in the green for 6 consecutive days now. Pull up a fortnight chart and you would see that ever since the earnings season started, which was last week, the Nifty IT index has been climbing higher and higher. Earnings today, you've got persistent from the mid-cap IT space, so that's going to be tracked very closely. IndusInd Bank, Rallies, Central Bank of India, those will be a few more stocks that we will track today on the back of earnings. Hi, what are you watching?
Hi, good morning. And guess what? There's less than 10 days for the budget, right?
Yeah.
So a big event is upon us. I'm watching out for a lot of these infrastructure names because generally ahead of the budget, these are stocks that start to rally. So the big question we're asking is there a pickup now in private capex? We know that there is government capex that has picked up for a while. And a couple of notes indicate that now private capex is also looking pretty good. In fact, L&T is the stock that has been hitting new highs. It's at a fresh record high today. And if you look at the chart pattern for L&T, right, the stock is now up almost 30% in just the last 6 months. So it should come up for you on your screen. And it's seen a 50% rally from the June lows. Now, why is that? BofA Securities put out a very interesting note today where they said that FY24 is the year when private capex will pick up in a big way and the acceleration will happen in FY25. So far, the capex was only supported by central government funding, but now what the government is doing is opening up monopolies to attract private and government capex, and hence there could be a lot of beneficiaries, L&T, the metal stocks, your Tata Steels of the world, the cement space as well. So these are themes that I'm looking at. And as I said, we're in the run-up to the budget. A lot of these stocks move with some fervor. So Nirmal Bang put out an interesting note where they said that the budget could announce a capex growth of 15% in FY24 and will be led by the road sector. So this is a space that perhaps could dominate mind space for a bit. What else are you watching?
I think today clearly belongs to the metals pack, right? There's that big CLSA note which has come through where they have several upgrades. Actually, a few of the larger names will be up on your screen, but they're saying the fact that China is reopening faster than expected and the stimulus has provided a new lease of life to the sector. So a lot of these stocks moving around on that news. Crude has seen a big rise overnight. It's actually almost at 87. So you're seeing, ONGC, Oil India, these stocks rally. Of course, negative for India, crude moving higher, but these stocks are definitely doing well today. The PSU banks, once again, that is the top sectoral loser today. SBI alone has lost around 4% this month. So, do keep your eye out on that. And speaking of banks, Reema, Sonia, Abhishek was pointing out something very interesting, that this is the first time in several quarters that HDFC Bank has actually outperformed ICICI post its results. So the performance will come up for you. This is the week-to-date performance. And you can see that this has happened after several quarters. And, another interesting point is that we all know that HDFC Bank is an FII favorite. So they have huge positions there. So do keep this and all of these stocks on your radar. HDFC Bank is up 2% this week versus ICICI, which is down around 1%. And the Nifty Bank overall has been quite flat. So that's what's going on with some of these names. Auto is also under pressure today, and there's lots of these smaller names which are moving around on their earnings. So the likes of Delta Corp, ICICI Lombard, Metro Brands, all of these, we'll talk more about that. But the key cues now are the US PPI sales data, which will come out, the retail sales data, and also crude at 87 is something that we need to track. So that's everything that we're watching from the market standpoint. But let me quickly run you through what we have lined up for you on the show today. The market is above the 18,100 mark, so we'll discuss the way forward for the market with Girish Pai of Nirmal Bang Institutional Equities.
Okay, we'll also be joined by the management of Neogen Software to discuss their earnings fine print on the back of a seasonally strong Q3.
ICICI Lombard slips in trade post their Q3 numbers. The earnings analysis is coming up for you on the show.
All right, and key excerpts of our conversations with managements of Dr. Reddy's, TVS Motor, the World Economic Forum that's underway in Davos, also lined up on the show. All this and much more in the next 60 minutes.
But let's kickstart trading now with a corporate. We've got Neogen Software joining in, came out with their numbers yesterday during market hours. Good quarter for Neogen Software. Now, December quarter is usually a seasonally strong quarter, and this time we've seen a revenue growth of 26% on a year-on-year basis. Margins have contracted, though, on a year-on-year basis. The stock currently is up close to just about 1%. In the last 3 months, it's gained close to about 10%. We're now joined by the management of the company to discuss it. We have with us the CEO, Virender Jeet, on the show now. Mr. Jeet, morning, and thanks so much for joining in. This is Rima here. 9-month FY23 revenue growth of 22%. Is there scope for you to upgrade your FY23 top-line guidance of 22%? And where do you think you will end FY23 with in terms of margins?
Good morning, and thank you for having me on the show. You're right. I think so far, for first 9 months, we had a broad-based growth across all the markets. And Q3 was strong with almost 26% growth for us. And you're right, seasonally, Q3 and Q4 are stronger quarters for us on the revenue side. And we expect Q4 to also be a strong quarter for us. And since they were larger in the revenue, they become the primary contributing factors to the margin. So it will expand from here. And, on the long term, the margin, our company generates, very high gross margins. We are in the software license business. And the net margins are completely a function of our investments in R&D and sales and marketing. We think we can sustain a margin of 17 to 18% net margin and around 20 to 23%, total EBITDA margins for the year as well as for the next year.
And for FY23, considering that Q4 is very strong and in the first 9 months, you've already done a 22% top-line growth. What could be the revenue growth for the full year? Can we touch 25%, say?
There's no reason we should not be able to, make it better than that. But whether it's going to be a 23, 24, or 25% would depend on really the outcome of how the deals flow. And, there's a, while it's seasonality, but we are basing our results also on very strong performances on Q2 and Q3. So we'll have to factor in that. But we are very sure that, our growth rates can exceed the growth rates which are right now up to 9 months.
Okay, so growth rates can exceed what you've seen in the 9 months of this year. But can you give us some insights, Mr. Jeet, on how the situation is from the client's front? Are you seeing any slowdown in terms of client spending, any delays in decision-making, any stress from the client's end that could perhaps impact your business in this year?
Not really. In fact, I think contrary to the kind of message around recession, I think we have seen contrary to the markets, especially in India, Middle East, APAC, which have been our traditionally strong markets. We are seeing strong traction from all our clients across all segments, predominantly in financial services, insurance, government. They've been very strong for us. We are, our revenue share from markets like US and Europe is just below 30%. So we are not really very strong in Europe. So our presence, we have just started operations out there. But in US, some of the larger clients are having concerns around what's going to unfold around next 6 months, 7 months. And some of those decisions are being slightly held back. But in most of our segments, we don't see any concerns right now. And on the back of our business being strongly built in emerging markets, we are quite positive that we'll continue the growth momentum.
All right, got that. Mr. Jeet, good morning and thanks for joining us. I want to ask you specifically on the India business because over there you've seen quite a jump come through, around 28% in terms of a revenue growth sequentially and also around 40% versus last year. Can you tell us what led to this sharp jump in the India business?
India, I think this business, if you look at track over last 8-9 years, it has been always like that. For a few years, it has a very strong performance and then it's become slightly, muted. And if you look at during the COVID era, India business was very slow for us. And in fact, most of the government as well as financial sectors were not performing at the same pace. But now that there is a kind of a demand which has not been serviced. But having said that, what is happening in segments like financial services where digital is leading the way, a lot of transformation projects are happening. And we have, one of the largest shares in banking and insurance, and we almost have, 90% of the market share in terms of presence in these accounts. Now, as these accounts are getting into more and more digital initiatives, we are finding more and more traction out there. I think that momentum can continue for next 2-3 years, and I think we're very positive about this market. But then, there is a government was pretty slow for last 2-3 years for us. Now it is picking up this year. The government has provided for us. That adds. Insurance, we are seeing, there's an activity that in next 2-3 years, there's going to be a lot of growth and momentum happening in insurance. So overall, we're very quite positive about the Indian market.
EMEA has seen a revenue decline of 4.5% on a quarter-on-quarter basis. I know, Virender, you prefer looking at your numbers on a year-on-year basis, but if you could just tell us why it's seen a drop-off on a quarter-on-quarter basis, and even the APAC profitability. The APAC profitability too is down quarter-on-quarter and on a year-on-year basis. If you could just explain what happened.
So I think you can check the EMEA is predominantly Middle East Africa for us and very little of Europe. We have grown roughly around 26% in that region in Q3. So I don't think there is any decline in any revenue. None of the regions has declined on revenue. I think the lowest is US for us, which has grown at 13%. And all regions have grown higher than that. Also on the 9-month basis, they're about 27% growth. So you could probably check that number order. On the APAC, on the margin side, right, what has happened, I think we have invested in subsidiary in Australia. And I think right now that subsidiary is in stages of formation of business. And so there is a lot of costs, but not much of revenue has come in from that subsidiary. So those costs have got added to the APAC region, which traditionally were not the costs. So on the that's why you will see there is slightly amount of margin decline. But we are very hopeful. What has happened, we have already booked a lot of businesses in Australia. And I think the revenue of those businesses will start flowing from next year. So the margins will again get restored back.
Okay. You said US revenue growth is the slowest, right? In all the regions at just about 13%. Any particular reason, any ramp down in large clients or projects?
Not really. I think we are on our own trying to reset the business model of the US. So we were pursuing kind of businesses which were giving us traction, but we didn't find them really, aligning with our long-term objective of the business in terms of growing at higher rates. So we are pivoting out there and slightly redefining the business strategy. And, we are trying to take a few quarters to make sure that it gets established. And after that, we should be very, comfortable of. In fact, we are pushing US to be the primary growth driver over next 4-5 months.
Okay, Mr. Jeet, we leave it at that. Thanks a lot for joining in. That's Neogen Software. By the way, the market is picking up some pace now, so don't lose sight of that. The Nifty is now almost 90 points higher, and the Sensex is at the highest point of trade, up 350 points. The big move has actually come in the last 10-15 minutes, so the market is really piling on its gains. Led by the HDFC twins, HDFC Bank and HDFC are both doing quite well. HDFC Bank, ever since its numbers, has started the up move, perhaps correcting its underperformance of the last many years. Let's do one thing. Let's take a quick commercial break on that note. Lots more coming up on the other side. We'll also discuss what's buzzing in the commodity space with Manisha Gupta. Stay with us. Welcome back to Trading Hour. Well, the market is looking quite good actually. Just don't lose sight of what's happening here. The banks are coming back in a big way, 250 points higher on the Bank Nifty now, led by the HDFC Twins, and Kotak Mahindra Bank too, ahead of its earnings, is looking pretty good. So we'll keep tracking this for you. In the meantime, we'll also talk about the commodity space. Manisha Gupta is joining in, and today the focus is on crude. Manisha, crude has been inching higher.
Oh, it has been, Sonia. It's been a good day for commodities yet again, and the crude oil price is also gained 2% overnight. They are trading in positive right now, and it's a one-month highs that you have seen for prices. And crude oil prices, after first week of decline, actually have turned positive now for 2023, even if just by 1%. But we are trading at multi-month highs onto this one. The support comes in after the OPEC global demand estimates that came in yesterday suggest that we are looking at a second straight year of demand build-up in 2023 as well, even if it's by 2.2 million barrels per day. But this is over and above 2.5 million barrels per day in the year 2022. Also, the China crude imports show a build-up for the month of December. After declining for 6 straight months, December saw crude imports jump up by nearly 4% in the year, and the China fuel exports have continued to gain up as well. December saw nearly 25% of a jump up on a month-on-month basis in those fuel product exports as well. There is continued supply of cheaper Russian crude oil into the international markets, and that perhaps is keeping the prices in check, is the reason we are not inching towards that $90 per barrel mark. But the markets will watch out for a whole host of data that is coming in today. You have the US retail sales, inflation numbers, and manufacturing activity, all of those numbers coming in today evening.
All right, Manisha, thanks a lot for getting us all of those, moves in the crude space and the cues that we should track as well. The market continues to pick up. It's a near 100-point gain that we're seeing right now. A lot of the banking names doing very well in picking up now. HDFC Bank at the high point of the day, Kotak at the high point of the day. Also, Reliance, which was in the red for the better part of the morning, has now moved into the green. So that is something I would watch as well. But that's the market action. We'll take a quick break now. But when we come back, we're going to discuss the technicals. Mitesh Thakkar will be with us. Guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. It's a 100-point gain that we are seeing on the Nifty right now. So we're at the high point of the day. The Nifty Bank is also doing quite well, around 0.6% higher there, led by HDFC Bank. You have Kotak, which is doing well. And a lot of the banks have picked up pace, even as, some of the smaller PSUs are still in the red. But let's get you a technical check on the market right now. Mitesh Thakkar joins us. Mitesh, good morning. So we're at the high point of the day, well above that 18,150 mark. How do you look at it right now?
Good morning. When we have been calling for a rally to 1850 or 18150, which has just been crossed, and then eventually to 18250. I think beyond that, one can look at saying that this pullback will extend and develop into some kind of an up move. So for the time being, I think revising the target to about 18,250, one. And I think any declines to about 18,060, 18,040 would be a buying opportunity with a stop below 18,000. The targets now are at 18,250, and once we start getting past them, then I think we'll look at higher levels. So trading with long bias in the short term.
And what about individual stocks?
Yeah, I have a buy on ONGC. I think that's the stock which is, after a few years consolidation, showing upward traction. So 147.5 is the stop loss, and would recommend a target of around 155 here. The other one is a buy on Tata Steel with a stop at 119.5 for targets of 130.
All right, thanks a lot, Mitesh, for that. Have a good day. We learned from sources that HDFC Life wants to enter the health insurance space and has applied to the IRDAI for that. Yes, Jen has more on that. Yes, over to you.
Well, that's correct, Sonia. So two very, very crucial developments for HDFC Life, both opening up two new businesses for the company. The first one is with respect to the indemnity health insurance market. What we've been given to understand is that HDFC Life Insurance has applied with the insurance regulator IRDAI. That is to seek an approval from the regulator with respect to entering the indemnity health insurance market. If you remember, just about a month ago, the government had floated a consultation paper under which it had proposed to change the Insurance Act, through which if approved, then the government intends to issue composite insurance license. What's a composite insurance license? It essentially allows life insurance companies to enter health insurance market and vice versa. And that proposal is expected to be taken up in the budget session of the parliament. But HDFC Life Insurance has already applied with the regulator, thinking that in case if that goes through in the parliament, then its proposal for entering the health insurance market will be considered by the insurance regulator. That's the first permission which has been sought by the company. The second one is with respect to distribution. HDFC Life has also applied with the insurance regulator, seeking the regulator's permission to distribute various financial products, and these include general insurance products, mutual funds, bank deposits, as well as loans. Of course, this is also a part of the same amendment with respect to Insurance Act, likely to be taken up in the budget session of the parliament. If it goes through, that this proposal from HDFC Life will also be up for consideration for the insurance regulator.
Yash, thank you very much for all those details. Need to slip into a very short break. As we do that, here is something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investor, that empowers you to make the right decisions with your money. A stock investor, I'm sure you've seen stock tips through SMSs, emails, YouTube videos, Telegram and other social media platforms. But did you know that wrongdoers use these channels to pump and dump stocks? Well, I would advise not to act on it blindly. A smart investor always conducts adequate research, analyzes the risk, consults only SEBI-authorized investment advisors to make an informed investment decision. You should go one step further and report any unsolicited stock tips to the exchange. Soch kar, samajh kar, invest kar. Welcome back. 18,150 on the Nifty. We're up close to about 95 points, 0.5% higher. Largely, it's been a steady day. Gains coming through in the first half of the trading session. ICICI Pru has the stock has recovered significantly from the day's low, but it's still holding in the red. And this is despite the numbers coming out better than what the street was anticipating. So just watch out for the way the stocks are reacting to their earnings. That said, ICICI Pru has seen a pretty good recovery from the day's low. But let's get you some more important corporate voices. This is coming in from the World Economic Forum underway at Davos. My colleague Shireen Bhan spoke to TVS Motors Managing Director Sudarshan Venu on the company's focus and the outlook for electric vehicles. Listen in.
EV is certainly a major focus. It's really front and center for us in TVS. We've invested substantially in a range of new products for EV, ranging from scooters to premium motorbikes, three-wheelers, passenger and cargo, and also electric bicycles for the European market. So we have the full range of products which we've invested behind. We've invested over 1,000 crores last year, and we believe we will maintain this pace for the next few years.
1,000 crores every year?
But that's the kind of scale that we are looking to really build a full product portfolio, strengthen the engineering team, build capacity and roll this out over a period of time. And I think therefore our capex has really shifted away from ICE and in a share terms, much more in terms of EV. I think if you see, the market has really started to grow, particularly in India. Last 3 months, we have sold over 10,000 iQubes each month. And we believe that the pace will only go up from here. And that also our new products will start coming into the market, which will increase volumes even further. Today, 10% of our scooters sold are already electric. And this percentage will go up as we go forward. So I think going forward, we'll maintain the course, continue to invest, focus on our core strengths of customer centricity, quality and technology, and build this out in a robust and sustained way over the next few years, by which time I think it will be over 25 or 30% of the market will be electric in India.
You know, when you're talking about 25 or 30% of the market being electric in India over the next 5 to 7 years, for instance, how are you factoring in the possibility of an era without subsidies? I mean, the FAME scheme, the current FAME scheme ends in 2024. Discussions and deliberations are on whether it will continue as is, if at all it will continue, or it will continue only for public commercial vehicles and not for private vehicles. Are you factoring in an era of no subsidies into your plans as you move forward?
I do hope the government will continue the subsidies, important for the industry until a certain threshold volume is achieved. But also through various partnerships, particularly on the battery side and cell side, I believe with increasing capacity, prices will come down. This is today the major reason why a subsidy is needed. And therefore, as this comes down and new formats of cells come out, new formats of vehicles, capacity comes up in India through the PLI, I think there will be a significant volume of electric, at which point the industry will become self-sustaining.
But, you know, if it doesn't happen, if it doesn't go through, I mean, there are fiscal constraints that the government faces as well.
Well, that you have to ask the government, but I do believe this is an important area to prioritize, particularly because of the amount of investments that have come in both from Indian players like ourselves and others, and also from startups and the foreign players in this whole EV space. But as I told you, irrespective of that, newer format cells are coming. There's more capacity being added in the cell space. All this is reducing the cost of cells, which is the major reason for the subsidy, and also there will be greater scale as we go forward. So the combination of these factors with greater domestic manufacturing, the PLI that's been announced, I think in some years the industry will really become a self-sustaining normal industry which won't need subsidies because of the scale and the maturity curve that the industry would have achieved by then.
Okay, so that's TVS Motor doing extremely well in the electric vehicle space. They are the #1 player. They're selling over 10,000 iQubes, which is their electric vehicle product, a month. And over 10% of their scooters that they sell are electric now. They're looking to grow that business quite a bit. Let's take a short break. On the other side, we'll discuss the way forward for the market with Girish Pai of Nirmal Bang Institutional Equities. Stay with us.
Welcome back. In big earnings today, you've got IndusInd Bank in the big banking numbers, and on the IT side, you've got Persistent System and Oracle Finance. So just to quickly run you through what the street is anticipating from Persistent and what we need to watch. Well, Persistent Systems is one trading at higher valuation multiples than its peers. The FY24 valuations for Persistent is roughly about 27.5 times. This is more than even large caps like Infi and TCS. So when your valuations are high, the margin for error is on the downside. Two, also this time, the revenue growth for Persistent Systems is going to be pure organic. Now, the revenue growth for Persistent Systems for the last many quarters has been very strong, and that's because it's been boosted by acquisitions. So if you look at the performance, it's been more than 6, 7, 8, 11%. There you have the chart over the last couple of quarters. That's been high because it's been boosted by acquisitions. This will be the first quarter where there will be no acquisitions contributing to the revenue, so pure organic. And finally, this company has a very high exposure to BFSI and high-tech. By high-tech, we mean companies like Apple, which have had to cut down their production due to supply constraints, etc. So these two companies, we've heard from peers, the furloughs are on the higher side. And Persistent Systems gets nearly 80% of its revenues from these two verticals, particularly high-tech, where the revenue contribution is nearing 50%. Is that going to impact demand? Is that going to spill over into the next quarter as well? So the street is going to be watching out for Persistent purely because its exposure to these two verticals, high-tech and BFSI, is on the higher side. The stock in the last 1 year is down 8%. From its lifetime high, it's down close to about 20-odd%. So just wanted to put a couple of points on board when it comes to Persistent and what we should watch out in their numbers. Girish Pai, the head of research at Nirmal Bang Institutional Equities, is now with us, and he's a close watcher, very close watcher of IT. And you've been negative on IT now for close to about a year. I remember your first downgrade had come out in April of last year, or was it even before that?
It was in April of last year.
Last year, right? And you know, that call has worked perfectly for you. But now we've started to see that IT companies are outperforming. The Q3 numbers are not as bad as what the street was fearing. Is it time to take a step back from your negativity, the extent of negativity that you had on IT? Your thoughts on what we made, the picture so far?
Firstly, thank you, Rima, for having me on your show. So I would continue to be cautious on the IT services space from a 12-month perspective. I think what's probably giving a leg up from a stock performance perspective for the IT services stocks is one, obviously, they've been down about 26, 27% in calendar year 2022. And they appear to be cheap, but my sense is that in FY24, the consensus numbers will have to be pulled down. And my own sense is that the PE multiples will also contract. Now, very specifically near term, I think that there are some positive data points coming through, especially on the US macro side. So when I put out my report in early April 2022, I was anticipating that US macro will kind of deteriorate by now. That has not happened. US macro has been fairly resilient, largely on the back of US consumption, which has been fairly strong and looks like it's going to continue at least for the next couple of quarters. So my assumption, and it's an explicit assumption of a shallow recession, is probably going to be pushed back towards the middle of 2023 or maybe second half of calendar year 2023. That's when probably, when probably we'll see the pain kind of come through. My sense is that between now and that particular time frame, the stocks can go up and down. But I think the worst is not behind us. Worst is ahead of us. But of course, there has been some bullish commentary coming out of at least some of the CEOs in Davos, for instance, kind of indicating that we're probably going to go into a soft landing and stuff like that. My own take is that we'll have to probably wait. And if you do go into even a shallow recession, I would sense that the earnings will have to be pulled down for the entire sector, and especially for the tier 2 stocks.
Okay. Girish, hi, good morning, and hope you have a great 2023. I wanted your thoughts on, a conversation that we just heard a while back from TVS Motor, where they are really aggressive in the electric vehicle space. They're already the top player over there in EV two-wheelers, and now there are big plans, expansion plans. In this entire, electric vehicle basket, electrification, autonomous vehicles, what is it that you like from a long-term investor standpoint?
It's very early, Sonia, to take a call on who's going to be a winner here. I think it's very early days in this space. A lot of people have taken bets. I think each individual auto player has taken a bet on this. Some of them have actually taken on board some external investors too. So as we look at it, we like TVS and also we like Hero MotoCorp for different reasons. In the two-wheeler space, while we think that growth has been a bit challenging on the two-wheeler side on an aggregate basis compared to the passenger car market, I would say on the EV side, Hero MotoCorp seems to be having a hedged policy where they're kind of betting on Ather, they're betting on their own product Vida, then they're probably trying to do some kind of a partnership with Gogoro, for instance. On TVS, I think they also seem to have their own set of strategies on the EV side. We like both. We like Hero MotoCorp because I think valuations are fairly inexpensive. It's probably going at about 14-15 times FY24 earnings, whereas TVS is probably going at 25 times earnings. But TVS, I think, probably has things going for it in one sense. If you look at the last 2-3 years, it's probably been the only two-wheeler which has actually seen margin expansion, whereas the other two have actually seen some kind of margin compression. And probably it's been the company which is invested in technology the most, and it's come out with good products. So we would bet on both. One is from a valuation perspective, and probably, I'm talking of Hero MotoCorp, and probably a turnaround in the rural side, which is probably going to be supported by spending by the government in calendar year 2023 or FY24 because of impending elections in May of 2024. So broadly, I would say that's where we kind of, that's how we're probably approaching the two-wheeler, these two players in the two-wheeler market.
All right, that is on the two-wheelers. Girish, something we have been talking about for the past few days is that with the budget, just around 10 days away now, we normally see this big capex push, right, in the budget. So do you think this is a good time to be looking at some of the metal names, the cement companies, the infra companies as well? Do you think that this would be a good time to put some fresh money here?
Yeah, so I would say at least that is our expectation that there is going to be a further capex push where they're kind of building in about 15% higher capex in FY24 compared to FY23. So whereas we think that revenue expenditure is probably going to grow in that 7-8% territory. So we do think that government will continue to spend. The beneficiaries of that will probably be the road construction players, cement players. Broadly, I would say those are the investable universe of stocks that we kind of covering right now. I wouldn't want to comment on metals. Obviously, metals is more a China play as we speak right now. And obviously with China opening up post its, putting aside its zero COVID policy, probably that space is kind of benefiting. On the cement side, I would think that, there is going to be margin expansion. Now, the extent of margin expansion is something that is questionable as we speak. because with China opening up, I would probably think that the industrial commodities will also kind of move up, and they've been moving up. So the extent of margin expansion, not just for cement, I think a lot of domestic focused sectors which are in consumer, auto, cement, and quite a few others where people are building in fair bit of margin expansion FY24 versus 23. I'm not sure how much of that is going to come out as actual in actual terms in FY24. But cement is a space, construction, where we kind of bullish on KNR and PNC. Those are areas where we would kind of put our money to work.
Girish, thank you very much for joining in. I remember even Rahul Arora yesterday was telling us that how you guys are betting on cement, PNC, infra, etc. Thank you very much for joining in. As we slip into a very short break, here is an important piece of information for all our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list.
Well, we've been getting a lot of commentary straight from Davos, so let's get you some more opinion. This is from the World Economic Forum. My colleague Shireen Bhan spoke to Dr. Reddy's chairman and MD GV Prasad on the company's focus and the outlook going ahead. Listen into what he had to say.
The pharmaceutical industry is not prone to macroeconomics, so the outlook is good. I think there is a lot more interest in investing in healthcare by governments worldwide. That should increase, expand the market. But most important things and interesting things that I found during this trip was the way AI is changing everything, how drug discovery is going to be changing, the whole concerns around supply chain, the war, all of that, and moving away from China. These are some things that are I'm seeing as trends for the industry.
So let's pick up on that trend that you spoke of, looking at options or alternatives to China, supply chain resiliency. Now, the Indian government also put forward PLI schemes to do exactly that on the API side as well. You've, of course, also been a beneficiary. But it's been slower to take off. The expectation is it will start to build, because when it was launched was also the COVID period, and most companies at that point in time were focused on COVID. What's the expectation as far as the PLI trajectory is concerned from here? So how has it worked for you?
The PLI is certainly encouraging for companies to invest in active ingredients and go backward and move the supply chain back to India. And we are seeing this kind of a trend globally. Many governments are encouraging localization of the pharmaceutical value chain. So in a sense, what India has done is good for the industry, good for the country. How much impact it will have, I think we have to see. It will take a couple of years to gain momentum, but in the long term, I certainly will help.
Let's talk about the US, because that has been a challenging market with a challenging environment. And of course, as you said, that while the macroeconomic environment doesn't necessarily impact healthcare, it could impact budgets, and it could impact fiscal ability of governments to spend. So specifically, as far as the US is concerned, what's the expectation? Do you believe that the worst is behind or yet to come?
See, the generic industry always operates under pricing pressures. This hasn't changed. And this I don't think will change substantially.
Will it get worse though?
I think we bottomed out on the worst. But going forward, I think the pressure will always be there. It won't be a sustained margin business. You will have spikes and then lows, but it continues to be a very attractive market still. It continues to be the largest generic market in the world. It's a market which is quite transparent, easy to get in. Once you get approved, you get market share. So I would still say the US is going to be a very important part of every large generic company in India, and that will continue, but it will have its challenges, and companies have to innovate, have to find ways to get growth, market share, and all of that. And I think the biggest competition is from our Indian companies.
Absolutely.
Driving the prices down.
Yes, your peers are your biggest competitors as well.
Yes.
But you talked about growth, you talked about market share. What can we expect by way of inorganic opportunities that you look at to grow both market share as well as get into new geographies and new segments?
So basically, we are concentrating on markets where we have significant presence, and India is a big priority for Dr. Reddy's. We'll continue to allocate capital for inorganic growth in India, and that has been, if you see the last 3, 4, 5 years, That is where we put our maximum capital in terms of inorganic. Of course, we are open to value-adding transactions wherever there will be, but our bias is towards branded markets, and in that, India would be the foremost market.
Anything on the anvil?
I can't talk about anything that's there.
Okay, but in terms of the launch pipeline now, what are you most excited about as the year unfolds?
So I think we had a great launch of Revlimid
Yeah.
that continues to generate value, and as you know, it's difficult for a generic company to predict which will be a big hit, which will be a less of a hit. We have a healthy pipeline, large number of launches in all major markets, and we look forward to growth.
All right, that is the Managing Director and Chairman of Dr. Reddy's talking about their outlook for 2023 and sounding quite positive. But on that note, we're going to wind down on this edition of Trading Hour. Thank you very much for tuning in, and Halftime Report comes up next.
Brought to you by Cello Vacuum